If you think silver is just a price on a screen, Beijing just proved you're wrong. Because while the world was staring at spot and celebrating new highs, a different market started talking in a different language, availability. And in the language of availability, the number doesn't matter unless the metal shows up. So today I'm going to walk you through a story that sounds like a price story. Silver hit $72 in Beijing, but is actually a delivery story. It's about vaults draining. It's about paperwork turning into power. It's about export rules flipping the world from market to allocation. And if you're the kind of person who hears export ban and thinks headline drama, I need you to listen closely. Because the export move I'm talking about isn't a loud ban with a siren. It's a quiet gate, a licensing gate, a quota gate. And once that gate exists, it changes how every ounce on earth gets priced. But let's start with the one thing everyone gets wrong. They assume the price is the story. It isn't. The story is whether the metal's available when you actually need it. Welcome back. Today's video is titled Silver Hits $72 in Beijing Vaults. The export ban just started. Now, before we go any further, quick note. I'm going to cite public reporting, exchange data, and official announcements where possible, and I'm going to separate what's confirmed from what's inferred, because in a market this emotional, people confuse a vibe with a fact. We're not doing that here. Here's what we know from public reporting. Reuters reported spot silver pushing to record levels in late December 2025, breaking $70 per ounce in global markets. Reuters has also reported tightness and unusual flows in the physical market in recent months, including large inventory swings in China's monitored warehouse system. And China's Ministry of Commerce has published rules governing state-traded exports for certain metals, including silver, for the 2026-2027 period, which implies export licensing and administrative gating rather than free flow. Now here's what we're going to unpack. Why $72 in Beijing can happen even if the global screen is showing a different number. What vaults drained actually means in practice, how inventories can be there but not movable. What a licensing style export regime does to arbitrage, premiums, and supply chain behavior. What happens next if this is a temporary squeeze or the start of a structural shift? Ready? Good. Because this is the kind of story that doesn't begin with an explosion. It begins with the exits. In a normal commodity, there's basically one price that matters. You can buy it, you can ship it, you can hedge it, you can deliver it. But in a stressed commodity, especially one with both investment demand and industrial necessity, you get a two-price world. Price A, the global screen price, the one everyone tweets, the one you can trade in milliseconds. The local, onshore, can you actually get it? Price, the one procurement teams whisper about, the one fabricators pay when their line is threatened, the one that shows up as a premium. That's how you can see a headline like, silver hits $70 globally. And at the same time, hear traders talk about onshore equivalents in the low dollar 70 seconds. Not because someone is lying, because the market is fragmenting. A two-price world is a symptom. It's the fever. It's the body saying something is constrained. And when that happens, the premium becomes a message. The premium says, sure, the metal exists somewhere, but can you access it? Can you move it? Can you clear it? Can you export it? Can you get it delivered on your timetable? When those questions start getting complicated, the premium becomes the price. So when we say $72 in Beijing, what we're really describing is onshore pricing pressure, a China premium, a delivery premium, an access premium, And that premium doesn't appear out of nowhere. It appears when inventories start to feel like they're draining, which brings us to the second part. When people hear vaults drained, they picture a cartoon vault with empty shelves. That's not how this works. Modern metals markets don't collapse because the last bar disappears. They collapse because the bars stop being available. And available is a narrower word than most people realize. Think of a warehouse system like layers. Total inventory metal exists in the system. Registered deliverable inventory metal meets certain rules. Movable inventory metal can be loaded out without friction. Unencumbered inventory metal is not pledged, leased, spoken for, reserved, or politically sensitive. Willing seller inventory. Someone will actually part with it. When stress hits, the bottom layers evaporate first. The metal can still be there, but it becomes conditional. And Reuters has described this theme repeatedly across commodities. Tightness shows up as premiums, inventory swings, and unusual flows long before you see a dramatic out-of-stock sign. In China specifically, Reuters has reported sharp drawdowns in monitored silver warehouse inventories during 2025, including large weekly outflows. Now, why does that matter? Because China is not just a consumer. China is a processor. China is a manufacturing hub. China is where silver becomes contacts, paste, cells, electronics components, medical parts. So if inventories are drawing down there, it can reflect real industrial pull. It can reflect hedging stress. It can reflect people grabbing metal before rules change. Or it can reflect all of the above at once. And here's the key psychological shift. In a calm market, inventory numbers are interesting. In a stressed market, inventory numbers are instructions. They tell participants how to behave. If stocks are rising, people relax. If stocks are falling fast, people don't wait. They pre-order. They over-secure. They double seal. They sign longer contracts. They pull forward demand, which leads to the behavior that creates a squeeze. Everyone tries to be early at the same time. And that's where export ban becomes more than a headline, because an export ban, or even an export licensing gate, doesn't need to be perfect. It just needs to change behavior. If you believe exports might be harder next month, you buy now. If you believe you might need a license next year, you lock in supply now. And when enough people do that, you get Beijing-style premiums. Now let's talk about the export ban phrase and why I'm calling it the quiet kind of ban, because it matters. When viewers hear export ban, they think of a dramatic announcement. No exports allowed, period. But in the real world, the most powerful restrictions are often administrative. They look like licensing requirements, quotas, state trading designations, approved exporter lists, end-use verification, credit track record thresholds, random audits, and enforcement that raises the risk premium. And according to reporting that cites China's Ministry of Commerce notices and related coverage, China has issued rules governing state-traded exports for certain materials, including silver, for the 2026-2027 period, implying export management through qualification and licensing rather than unrestricted flow. That doesn't mean no silver leaves China. It means silver leaves China through a narrower pipe. And when the pipe narrows, the people at the front of the pipe get cheaper metal, and the people at the end of the pipe pay premiums. That's allocation. Allocation is not economics. Allocation is power. Now, add one more layer, timing. If the market believes a tighter export regime begins the 1st of January 2026, what happens in late 2025? You get pull forward behavior. People front load shipments. They hoard inventory. They buy just in case. That behavior drains vaults, and it creates the sensation of an export ban starting before the calendar flips. Because functionally, if everyone is trying to beat the gate is already influencing the market. This is why headlines can be misleading. The export system might start on a date, but the panic starts when the market believes it. So, in that sense, yes, the export ban just started, not as a law, as a behavior, and behavior is what moves prices. Now let's connect this to Beijing's number and why the global screen can't capture it, because there's a reason silver loves to do this. Silver is small, silver is thin, silver is leveraged, silver is half monetary narrative, half industrial necessity, which means when it breaks, it doesn't crack like gold, it snaps. And we are watching that snap form in slow motion. Here's the mechanism. Imagine two rooms. Room one, a trading desk, screens everywhere, charts, options flow, people yelling calls and gamma. Room two, a procurement office, quiet, deadlines, bills of material, a factory line that costs money every minute it's down. In room one, the question is, what's the price? In room two, the question is, can you deliver? Those are different universes. In a stable supply chain, they stay aligned. In a stressed supply chain, they diverge. Now, how does that divergence show up? China premium. If domestic demand surges, industrial or investment onshore prices can trade richer than offshore spot. Bottlenecks. If moving metal across borders faces friction, shipping, paperwork, inspections, licensing arbitrage can't instantly close the gap. Policy risk. If exporters believe rules are tightening, they demand a higher margin or simply hold back. Inventory optics. If warehouse stocks are visibly draining, everyone pays up for certainty. And here's the most important point. The premium is not just about demand. It's about trust. Trust that the metal will be there. Trust that the paperwork will clear. Trust that the counterparty will ship. Trust that you won't be the one left holding a contract instead of a bar. When trust fades, people pay for certainty. That's why in commodities, prices don't explode when the chart looks pretty. They explode when confidence breaks. Now, Reuters has described silver's surge as being driven by a perfect storm of factors: investment demand, industrial demand, supply deficits, and tight physical conditions. And you can see that storm forming in the way the market behaves. ETFs pull metal, refineries run hard, premiums pop, delivery time stretch, inventory data starts looking like a staircase down. That staircase is what people mean when they say vaults drained. Let's talk about the number, because I know some of you are thinking, okay, but how do we actually get to 72 in Beijing? Here's the clean explanation. China's main onshore reference is its domestic pricing and futures market structure. Those prices are commonly quoted in RMB per kilogram for certain silver contracts. Global headlines usually speak in US dollars per troy ounce. So when people say Beijing printed $72, what they usually mean is after converting the onshore RMB kg price into a USD Oz equivalent and adjusting for currency and local basis, the implied onshore level was in the low dollars 70 seconds. That can happen for three reasons. Currency moves. If the dollar weakens or the yuan strengthens, the same local price can imply a higher USD equivalent basis. If the local contract is trading at a premium to offshore spot, the conversion comes out higher. Friction. If it's hard to move physical across borders quickly, the gap doesn't instantly close. Now, in a perfectly frictionless world, a premium like that gets arbitraged away. Traders buy cheaper metal in one market, sell in the expensive market, ship it, and close the gap. But here's the whole point of today's video. This is not a frictionless world anymore. Export management, licensing, timing, paperwork, risk of delay, risk of denial, risk of enforcement. Those risks make arbitrage slower, and when arbitrage slows, premiums can persist. That's why a China premium is not just an interesting stat. It's a stress marker. It's the market telling you metal is not flowing freely. And when metal doesn't flow freely, price stops being a single global truth. It becomes a set of local truths. That is how you get $72 in Beijing, while everyone else is still arguing about $70 on the screen. Now, if you want to know whether this is real or just talk, here's your test. If the premium holds for days and weeks, if lead times extend, if inventory trends stay negative, if paperwork tightens, then the premium is real. If it flashes for an hour and vanishes, it's just heat. We're not in the business of chasing heat. We're in the business of tracking structure. So now, let's talk structure. Specifically, how a market becomes structurally fragile, because silver is fragile, and that fragility is why this move is so violent. Let's break the fragility down. In a normal market, money solves problems. You pay more, you get more. In an allocation world, money is necessary, but not sufficient. You also need relationships, credentials, end-use story, timing, priority status. This is how strategic materials behave, not how normal commodities behave. And if China is tightening export administration for silver, even via licensing and state trading gates, that pushes silver closer to strategic material behavior. Now, what does that look like on the ground? Picture an allocation hub like an airport terminal, one lane open, others gated. Priority customers glide through. Everyone else stands behind velvet ropes, holding blank weight tokens, watching the metal move, but not toward them. That's the future of a commodity, when availability becomes conditional. And if you think I'm exaggerating, we've already seen this movie in other materials. Rare earths, magnet metals, battery metals, semiconductor-linked minerals. In each case, the story begins the same way. Nothing to see here. It's just a license. It's just paperwork. Exports will continue. Then, a few months later, a surprise shortage, a surprise premium, a surprise shutdown, a surprise geopolitical headline. Paperwork doesn't sound dramatic until your factory is the one waiting. Now, does that mean silver is officially banned? No. It means the system is being redesigned to prioritize internal needs and managed exports. And in a tight market, that redesign matters because silver is not optional in many applications. You can thrift it, you can reduce it, you can try substitutions, but you can't replace it everywhere without pain. So the question becomes, who gets the ounces? And once that question exists, the market is no longer just a market. It's a rationing conversation. Now let's zoom out and look at why this is happening now, because it's not one cause, it's a collision. Let's walk through the collision. Silver is not gold. Gold is a deep ocean. Silver is a fast river. Gold has central bank demand as a major stabilizer. Silver has industrial demand that can spike without warning. Gold has huge above-ground stockpiles relative to annual flows. Silver has stockpiles, but they're scattered, pledged, industrially embedded, and not all available. Gold is mostly a monetary story. Silver is a hybrid. That hybrid nature is what makes it explosive, because silver has two types of buyers. Buyer A, the investor who wants a store of value, the manufacturer who needs a component. When buyer A panics, it's emotional. When buyer B panics, it's operational. And operational panic is terrifying because it doesn't care about valuation. It cares about not shutting down a line. That's why silver squeezes don't look like normal rallies. They look like stampedes. Now, add derivatives. Silver's paper market can dwarf the physical flows. That creates a strange situation. The chart can look liquid while the warehouse is tight. So the market can have two realities. Financial liquidity, lots of trading. Physical illiquidity, not enough freely deliverable metal. And when those two realities diverge, you get the thing that breaks markets, a sudden demand for delivery. Not everyone asks for delivery. Most people roll contracts. Most people close positions. But when confidence breaks, more participants say, no, I want the metal. And the moment that happens, the paper structure becomes a stress test. Can the system deliver? Can it deliver to everyone who wants it? Or does it deliver to a few and force the rest to settle in cash? That is the nightmare scenario in any physical commodity. And I'm not saying it's guaranteed. I'm saying this is the kind of environment where the question becomes meaningful. And the moment the question is meaningful, the market reprices risk. That repricing shows up as premiums, higher borrowing costs, and sudden warehouse moves, which brings us to the next piece. What vault drain looks like mechanically, because it's not one big event. It's a chain reaction. Let's walk through the chain, why this is happening. The collision, there are four forces colliding. Industrial demand that doesn't care about your feelings. AI data centers, electronics, EVs, solar, these are not hobbies. They are infrastructure. And infrastructure demand doesn't fade politely. Investment demand that's waking up. When silver breaks levels the public believes are impossible, it creates a new kind of buyer, not the patient allocator, the panicked allocator. 3, inventory drawdowns. When the market runs deficits, above ground stocks are what fills the gap. And once those stocks start shrinking, the system becomes more fragile. 4, policy and geopolitics. When nations treat materials as strategic, they don't always ban them. They manage them. They control them. They make access conditional. And when those four forces collide, you get a market that behaves like a stressed credit system. You see spikes, you see gaps, you see premiums, you see sudden rule changes, you see liquidity on screens and illiquidity in warehouses.
Now, Reuters has reported record moves in silver and highlighted tight supply conditions as part of the rally narrative.
And it has also documented big physical flows and the sensitivity of the supply chain in 2025. Put that together, and you get the core theme of this video. Silver is transitioning from a price-discovered commodity to a priority allocated material. And that transition is where $72 in Beijing makes sense. Because Beijing isn't pricing a metal. Beijing is pricing security. Security that you can source. Security that you can ship. Security that you can build. Now let me tell you the uncomfortable part. If this transition continues, $72 won't be the story. The story will be the day when the global price and the local premium break apart so violently that the chart looks calm while factories panic. And that sounds insane until you've lived it. So let's talk about the visible signals. The signals that tell you whether this is real, because they're always signals. And in markets like this, the boring signals are the truth.